Hi everyone, welcome to the release of the CreditorWatch Business Risk Index December 2021 results. I'm Michael Pollack, the head of content at CreditorWatch, standing in for CEO Patrick Coughlin, who's enjoying a well-earned summer break. James O'Donnell, the managing director of Open Analytics and the creator of our index, is joining me to discuss the results today. Welcome, James.
Thanks, Michael. Great to be here.
We've obviously got a lot to talk about. Before we get into it, I'll just run through a couple of slides to go through some background on CreditorWatch for the people that are new to our webinars. So CreditorWatch is Australia's leading commercial credit reporting bureau. We have more than 55,000 companies subscribed to us. They use our services for a range of purposes, customer onboarding through to alerts and monitoring, portfolio health checks, debt collection tools, and integration with accounting systems. There's a number of benefits to integrating with accounting systems. Next slide, please, James. Thank you. Just a few highlights, recent highlights from CreditorWatch. As I said, we've got 55,000 customers. We have identified more than 330,000 adverse cross directorships. And we have 10 million trade lines collected from Xero and MYOB integration and age trial balance data. Now, if you have integrated your Xero or MYOB packages with CreditorWatch, we have a bit of an offer for you today. We're giving away a $200 voucher to everybody who would like to give us a bit of a testimonial on their experiences with the integration of their accounting package with CreditorWatch. So if you're interested in collecting a $200 voucher, just put your details in the comments window on the right of your screen. And as always, we welcome your questions. So feel free to put them in the GoToWebinar panel. We always attempt to get to every question. And if we don't get to you, we will always endeavour to email you with a response afterwards. Okay, let's get into it. Now, obviously the elephant in the room today is Omicron. Retailers obviously have been really struggling with consumer confidence at its lowest level in more than 30 years. The New South Wales Premier last week noted that Omicron has created a $350 billion hit to the New South Wales economy. On the positive side, employment numbers from last week showed that there was quite a bit of momentum going into the end of 2021. But the big question is, can that continue? That's something that James and I will hope to shed a bit of light on for you today. Can activity bounce back? James, I'll hand over to you now to take us through your findings for December.
Thanks very much, Michael. Okay, so today we've got the results from basically the year-end results on the BRI, or the Business Risk Index data. So we're sort of taking the opportunity this month really to do a bit of a year in review. So I'll focus a bit on the current month, but also sort of talk a bit more broadly about what's happened over the last sort of 12 months. Okay, so look, probably the key finding, sort of number one, is the big contraction in trade receivables, or B2B, business to business trade activity. So sort of really this year, headline there is really that Santa didn't show up for small businesses this Christmas. So this is a bit of a different look at the data that we always show on trade receivables. What this chart shows is the average dollar value of trade receivables for all of our small business data suppliers. So those data suppliers where we source from accounting software integration. So you can see that I've highlighted the December month, and you'll probably notice the seasonality in the data. So what we typically see is over the quarter from, say, running from September to December, we normally see a big pickup in B2B trade activity due to Christmas. So that Christmas spending spike is normally something in the order of 20 to 30%. And you can see this year, basically, if you look over that quarter, it's basically gone nowhere. So if you look at the kind of the Christmas numbers this year for December 21, it's actually down 45% on the same time last year. And that's a pretty stark number, particularly considering last year we were also in a pandemic. So we're off about 10% last year. So I think if you look back for some of you with a long memory, a couple of podcasts ago, I was actually predicting a big bounce back this Christmas. We actually thought that things would really roar back, but of course we didn't predict the Omicron. And really interesting, compared to the other lockdown periods, this kind of, there's no lockdown, but there's what's been referred to in the media quite a bit as a shadow lockdown. So you're allowed to go out to the restaurant or the pub, but people are choosing not to, basically because Omicron's running rampant through the population. It's not helped by the supply chain disruption and labour shortages for people calling in sick because they have Omicron. So
Sorry, James. I guess it's also showed how valuable JobKeeper was to the economy last year, and how, I guess, how badly assistance is needed now.
Yeah, of course. Yeah, so it's worth pointing out that this time round, trade activity is down, but there are no government support out there. And look, and banks and the ATO are starting to reinitiate sort of collection activities as well. So, and obviously particular sectors around hospitality and tourism are the worst hit. So that's sort of the look on sort of business trade activity. I should say that there's other data that's been released in the media from the big four banks. I think ANZ released some consumer spending data, and reporting a similar thing, that kind of consumer, spending on debit and credit cards is sort of at the lowest level it's been in a long time as well. Okay, so moving on to the key headline around sort of default predictions. Of course, the business risk index fundamentally predicts insolvencies. So probably the key story here is we've seen that turning point in the reduction in insolvencies, which was really driven by JobKeeper and creditors sort of putting a pause on collections activities. So you saw that, whether you're looking at the line in the centre there is a national average. The top line there's the kind of the bottom ranked 10% based on our business risk index, so the high risk regions, and of course the lower line's the lower risk 10%. So whether you're in that best 10%, worst 10%, or somewhere near the average, we've seen that kind of reduction in annual default rates has been arrested, and we're very much expecting that to rise over the next 12 months. Okay, so they're probably the top level sort of aggregate numbers. Now, as I mentioned, we've done a bit of a deep dive into how people have sort of performed across the year. So to start with, if we just take the December year-end position snapshot, what are the highest and lowest risk regions from an insolvency perspective based on the business risk index? So to the right of that chart, so just to recap that the index basically ranks regions by their relative insolvency risk. So on the right there, sort of the regions that are near zero, they're basically the highest insolvency risk regions in the country. And sort of repeating what we've said throughout the year, it's really a story of Western Sydney, sort of around Canterbury, Bankstown, Green Valley, Bringley, Maryland's Guildford area. And then also the Gold Coast region. An interesting one that sort of crept into that bottom five is actually not on the Gold Coast, but still within Queensland. It's actually Springfield Redbank, which is actually near the Ipswich region. But if you extend that out and sort of look at the bottom 10, most of the rest of the bottom 10 are around sort of the Gold Coast and Sunshine Coast. At the other end of the scale, if we look at the lowest risk regions, they still tend to be regional areas. So places, they're all in Victoria and South Australia. So regions that tend to be either, agribusiness or local tourism areas. So the Limestone Coast in South Australia, which is a bit of a agribusiness / sort of winery region. And an interesting sort of story there is a lot of that sort of in Victoria and South Australia and New South Wales to some extent, some of the kind of local tourism areas are actually going quite well because people can't travel to, for example, the Gold Coast or travel either interstate or overseas. So they're the sort of top and bottom 5 at a very sort of granular level. If I take it back up to the state level, the chart we often show sort of tracking the states. So not too much movement month on month for December. So, you know, South Australia is still the lowest risk for insolvency of the major states, and Queensland's at the other end of the scale. Of the major states, really, New South Wales, Victoria and WA have converged quite a bit. So they're fairly similar sort of risk. Probably the most interesting thing is how the states have moved over 2021. So what this chart shows is basically the change in the aggregate business risk index by state. So what this basically shows is how states have been moving relative to each other. So the best performer is WA, which we've talked about sort of all year. You know, really WA is sort of primary industry driven, you know, can basically chug along pretty well with its borders shut, given most of its economy is driven by mining and agribusiness. ACT, Canberra, the government bubble is pretty insulated from everything that's going on. So they're sort of the top 2 there. South Australia and Tasmania perform pretty well also. At the other end of the scale, so Queensland, as we mentioned, really dragged down by those tourism areas, sort of particularly around the Gold Coast, as I mentioned. So it's sort of the external border closure has really driven a lot of that. And then Victoria's really been dragged down by the Melbourne CBD and urban areas around the city. So it's really a story of Melbourne dragging Victoria. And as we've mentioned in previous webinars, that some parts of regional Victoria are actually going quite strong, but the biggest sort of population centres have been hit pretty hard by those lockdowns.
Okay, so a long, slow recovery for Melbourne by the looks of it.
Yeah, it's looking that way, particularly in the inner city areas in particular.
And the WA Premier, Mr. McGowan, would be very happy to see that chart, I'm sure.
Yes, I'm sure he would. Yeah, so yeah, it's quite an interesting story, WA. So, and you'll see it when I get to the next slide, even sort of Perth as a capital city has been really strong as well. So if you look at this chart shows our large regions, so regions with at least 10,000 credit active businesses in them, so filtering out some of the smaller regional centres. So the top performers, it's an interesting one actually. Newcastle has been sort of moved up 10 points, so it's actually relative to the rest of the country has improved quite a bit on its insolvency risk. Again, it's sort of a mirror of something that's happening across the country, where the sort of big regional centres are tending to significantly outperform the cities. So Newcastle, of course, you know, it's sort of the capital of the Hunter region. So sort of, you know, you've got a lot of primary industry there around both sort of coal and agriculture. So doing quite well, Newcastle. Perth is the other one, and Perth is really a mirror of the wider sort of state story. So Perth is by far the best sort of performing capital city. Then some of the other good performers, Strathfield, Burwood, Ashfield, it's still a fairly high risk region, but it's sort of bounced back somewhat from the doldrums of the worst of, you know, the original lockdown. So they've sort of bounced back a little bit. Lane Cove is a bit of sort of the opposite of that, where it's actually quite high on the index, but has sort of come down a little bit over the year. Then if you look at sort of the other end of the scale, very much, you know, the worst performing areas are basically suburbs of Melbourne. So with Monash and Boroondara, sort of, you know, Melbourne, outer Melbourne suburbs, both of those. So look, that's the kind of story of the biggest movers. To finish with, I'll just talk about some more sort of general industry sort of reporting and statistics coming out of CreditorWatch. So credit inquiries, probably not too much exciting to say for the December numbers there. December sort of credit inquiries were down. December is normally a slow month for banking and credit, so that's pretty sort of normal there. So we're not seeing much lending, which is pretty understandable given the current situation. Administrations, again, now this is just looking at a spot month, number of companies entering administration. Again, December is typically a slow month, so it's sort of down or slash flat sort of spot month insolvencies. But as I mentioned, if you look at the year as a whole, it's gone up, starting to go up a little bit. Court
That's still
actions
down,
again.
just still down quite a bit though on the pre-COVID numbers, which were sitting around 800 per month. So it'd be interesting to see what happens there with our January data, whether there's a jump there.
Yeah, look, I think we'll start seeing that the insolvencies very much start heading up this next quarter. So I think you'll start seeing those rolling through. I mean, a lot of creditors aren't active in the December months, effectively. Court actions, similar sort of thing, sort of, not pretty, so probably not too much to say on that front. And then if we sort of look at the industry split, and same story as the whole year really, sort of the hospitality, food and beverage industry is kind of the highest insolvency risk, followed by sort of arts and recreation services. But obviously the hospitality industry is the real sort of outlier. Then at the sort of positive end of the scale, sort of agribusiness, healthcare is an obvious one in a pandemic, but sort of agribusiness and manufacturing have been a good story all year, so quite low insolvency risk there. And then another way of sort of looking at sort of payment behaviour, construction is sort of the highest proportion of businesses with 60 days late payments, and this is payments to our what we sort of term our small to medium business data suppliers, so those with the accounting software integration. So construction, the lead there. I mean, there's obviously some potential risks for constructions with the prices of raw materials, and due to sort of supply chain issues is potentially a big risk to the construction industry to keep an eye on. And then sort of you see the kind of step change at the other end of the scale with again sort of healthcare and agribusiness sort of leading the charge there on the best payers. So look, that's the sort of key sort of findings. I guess probably the headline, I'd really come back to that sort of business trade has really fallen off a cliff. Look, it's very. I'm often asked to kind of predict the future, with what's going to happen this year, and I've probably been burnt a bit, being probably a bit too optimistic. I think I will still say that once the one sort of positive thing is that across the industry and consumers as well, savings are quite high. So when touch wood, when we actually do get out again and we can sort of revert back to normal, there is actually cash there to spend and flow into the economy. So I'll leave it there. So happy to sort of open up to any questions, and I'll hand back to Michael.
Thanks very much, James. That was great. And let's hope that there's been a bit in the media about us saying that we're nearing our peak. So let's hope that is the case, so that the business community can get back on its feet. And as you say, we can open our wallets and get out there and start enjoying life again. Okay, now as usual, we run a poll at the end of our webinar. So if you could please just let us know if you'd like to be contacted by a CreditorWatch team member. Okay, well that concludes our webinar for today. Thank you again for joining us. As I said, we were a bit late in releasing the results this month, I should say, after having a break, but we'll be back with the January results on the 9th of February, so please join us then. James will be back, and hopefully Patrick will be back as well after his nice break up on the beaches. So thank you for your time, everybody, and stay safe.